Hey everyone, welcome to another episode of The Remote Real Estate Investor. I'm Mike Laubaum, and today with me I have Derek Dombeck again on the podcast. And for those of you who missed his first episode, I highly recommend you going back and giving that a listen. But Derek is the owner of Best REI Funding, a private lender. He's also an investor. So today we're going to be talking about private lending and also what we need to know as investors and how to utilize it. So let's get into it. Derek, what's going on, man? Good to see you. Thanks for coming back on the pod.
Yeah, absolutely. Glad to be back.
I'm super excited to have you on. So last time we talked about creative financing solutions for real estate investors. Now we're going to be tackling kind of the other side of the coin. And so talk to us about private capital and lending and how that plays into real estate investing.
Well, I like to talk to our clients that are coming to us for loans in more along the lines of how would they want to structure it if they were the lender. So it makes more sense to them. Why are we asking for what we're asking for? We designed our company primarily because we were borrowers ourselves, and we wanted to do it in a way that would be pro-borrower, but still safe for our investors. So a couple examples, we don't collect monthly payments. We don't collect interest payments. We let it accrue. Very, very few lenders do that. The methodology is that when you're the lender and a payment is missed or late, that gives you an indication of something could be going wrong with the loan. And that's true, but we don't want to have to collect payments every month on 175 outstanding loans, which is typically what we're carrying at any given point in time. It's another staff member that we would have to have basically just to do that, do collections. So as a borrower, when I was borrowing the money, that's what I would have wanted, right? As a lender, it's different. So a lot of times I'm trying to have these conversations with our borrowers, as I mentioned, in a way that shows them that we're their ally. We're not just somebody sitting across a big fancy desk with a suit and tie on looking down our noses at them. We want them to really realize that we are their business partner in one way, shape, or form. Most interactions with the borrowers, if they've never met me before, it just starts out with a brief overview of our loan program. And I often tell them, well, if you were going to be the lender, if it was your money, what would you want to see happen? Especially if if your listeners are out there trying to apply for loans. There's 2 to 3 things that I think are super important. The first one is whether they're going to a bank, a hard money lender, or a private lender, or their great uncle, have all of your documentation ready to go at the drop of the phone, right? Like we get off the phone, bam, you can submit it. What drives every lender crazy is when they send stuff in piecemeal, and we always have to ask for it. And then we have to remind them and follow up. That makes you look so foolish in the eyes of a lender. Okay. Another thing for us, we don't require appraisals, but most people do. And we don't require appraisals in our loans because I don't trust appraisers. They have no skin in the game. We have way more experience, but we're in a niche lending market of lending on rehabs. And some appraisers may never have picked up a hammer in their life. How do they know what the after repair value is going to be based off of a scope of work? So
Great point.
If I get a scope of work that's submitted on an application and they claim they're going to put a brand new kitchen in for $2,000, I'm going to call bullshit because I know what it costs to put in a low end, middle end, or high end kitchen. Yeah. But again, as a borrower, trying to help your listeners in that regard, if you're going to an appraiser or you're coming to us and we don't require appraisals, but having your data somewhere, you had to come up with your numbers, right? When you made your offer to buy the property, I want to see, an appraiser may not want to because some of them don't necessarily like the help, but I want to see, because, Some of them are just arrogant. Let's be honest.
It's the ego play. Yeah.
It's an ego play. But for me, it's not. For me, it's required. I want to see those comps or a CMA or a BPO from a real estate broker, something to show me how did you come up with your valuations. If it's going to be a rental property, where's your cash flow analysis? You wouldn't believe it how many times we get, applications in and they want to borrow money from us short term to fix the property, get a tenant in there, and then refinance. But yet they have not talked to any long-term lenders, typically banks, to even know what their refinance terms would be or if they'd be able to get refinanced. They haven't done a cash flow analysis. Again, have everything ready for your lender as much as possible, right? Gosh, what else? As a borrower, coming in with a backup plan, a plan B, is so crucial. Our job as the lender is to expect you to fail. And every question we ask is asked because we want to know if something goes wrong, can we either take the property back or lean against the borrower to get our money back? I mean, that's what it's all about. We are asset-based lenders. Banks are going to look at the asset and their income. Every lender is a little different. But the bottom line is, can we protect our investors' money? Can we protect our money? And if that borrower walked out of closing, signed the papers, and got hit by a bus and died, can we recoup our money? Right? Borrowers don't think that way. Borrowers think sunshine and unicorns, right? Nothing's ever going to go wrong. The project's going to be on time, on budget. We're going to get
under
above
budget.
asking.
Yeah.
It's total bullshit. But that's our jobs to explain that to them in a way that, we're not trying to drive them from our business. We want to do business with everybody that's got a legit good deal, but they've also got to be realistic. And the number 2 spots that most borrowers come in, sunshine and unicorns, their budget is too low on their renovations and their comps are too high. So they want to use the top comps and we don't. Why don't we? Because the markets shift. Now, if they came in on a valuation, I'm going to use Wisconsin numbers, because that's what I'm used to. If they come in with an after repair value of $200,000, and I look at the comps that they submitted to me, and there was one house that sold for $200,000, but the majority of them sold for $175,000. Which ones do you think I, as a lender, want to use?
Yeah, the 175.
Right. So we're going to lend based on the 175. Now, that means they're going to have to put some of their own or more of their own money into the deal. If they sell for 200, bonus for them. That's great. I hope they can. But as a lender, we can't live on hopes and dreams. We got to live on reality. And what happens most of the time is they're trying to come in with as little money out of their pocket as possible by using the highest comps. The lender takes on all the risk, which is why we use the middle of the road comps. And I don't go to the very low end either, but we're using the middle. And again, if they have to put in $10,000, $20,000 extra dollars and they're confident in their numbers, they shouldn't have a problem putting in $10,000 to $20,000 extra, because according to them, it's going to sell for $200,000. They should get their money back and then some.
Right.
But when you start changing that or having that conversation with them, boy, it's amazing when they have to use their own money, how they start to sing a little bit different tune.
Yeah. Interesting. So it's almost like you have to protect them from themselves.
Absolutely. And we will tell them that. I mean, there's plenty of times where we have just flat out told people, you should walk away from this deal. Like, we want to do business with you in the future. We want to give you a loan, but you are setting yourself up for failure on this deal. And most lenders wouldn't typically do that. Most lenders would just say, we're only comfortable lending up to X. Go ahead and do the deal. And then when they fail, the lender would take the property back.
Right.
And the lender's in good position, depending on the loan to value. But I don't really like that model. I mean, it's certainly not our model. And at the end of the day, if I take care of that investor and I save them from themselves this time, hopefully when they come back around, they're more educated and they bring us a really great loan. They've got a really great project. That's what it's supposed to be all about.
Yeah. Yeah. Well, let's talk about that for a minute, Derek. So it sounds like the things that you ask for from your borrowers, it's really an opportunity for them to showcase their experience level, that they've crossed the T's, dotted the I's, and really thought about it and been very proactive in that. What if someone's just getting started? I mean, how much hand-holding should someone expect from their lender, or can they expect from their lender to help them get to a point where they're feeling confident? Or do you tell people, hey, you know what, go kind of skin your knees somewhere else and then come back to us when you're a little bit more polished?
So the answer is it depends. There's most lenders out there do not want to deal with brand new people.
Right.
I mean, it's just a reality of life. We are different in that regard too, because we may say to the applicant, all right, we want you to partner with somebody, and that person has to have, we like to see at least 3 deals worth of experience. Now, I don't care if they get mentored for free or if they split the deal 50-50. I don't care what that partnership looks like, but we would like to see somebody with experience that is backing this deal. Mm-hmm. And if they can't do that or they don't want to do that, then we typically would say, sorry, but we can't lend on this deal right now. And if they don't know anyone else, which happens, we have an extensive network throughout the state. So we can pretty much in any market, we can line them up with somebody that would be willing to mentor them and get some feedback from them. So, but I don't think there's a whole lot of lenders that would do that much hand-holding.
Yeah.
And
that makes sense. Walk us through, because you're a private money lender. So you are kind of this middle person where you take investor money and then lend it out to other investors that are then buying real estate. So when the Fed talks about interest rate hikes or this sort of thing, like how do you set your pricing, and what should listeners be expecting if they're going to private lenders in terms of rates? Right now, we're recording this almost near early September, end of August, 2022. What are you seeing, and what should people be expecting?
So it's very volatile depending on where you are in the country and how much competition there is. We certainly have national hard money lenders that are advertising much cheaper rates than we offer, but they sell off their loans almost, before the ink is even dry. They're white labeling almost everything, which means that there's a hedge fund or another note buyer that is fronting the cash to close the loan, and at the closing table, that loan gets transferred. The person that you signed the paperwork with may still be the servicer of the loan, so you may not even realize it's been sold off. But most of the national lending companies, that's what they do. The challenge with that is when the borrower gets to any kind of a challenge, we'll call it, with their loan, maybe they need an extension or something's just going terribly bad, those lenders are not going to be willing to work with them because they don't own the loan anymore. It's gone. It's in some hedge fund on Wall Street, and it's just a number. It's just a loan number. They don't care. They just, okay, you failed, get out, we'll take your property. As private lenders, we don't sell off any of our loans. We are 100% privately backed, so I don't have any institutional money at all that has their thumb on us telling us what we can and can't do. And our investors are all individual people. They're some are mom and pop, some are a little bit higher net worth individuals, but we can have conversations with them. So, for example, let's just assume that the market's crashed and 20% of our portfolio defaulted, and we had to go take these properties back. Well, if the market isn't really a viable option to sell them off and be made whole, we can go to our investors, and we've done this with all of our investors prior to them even getting started with us. We have this conversation, but we can go to them and say, okay, we still, myself and my business partner still run a full-time real estate acquisition company. We have rentals, we have everything in place. So we're going to have to take these, whatever it is, 20, 30, 40 properties, and we're going to lease them out. And we're going to just collect rents until the market comes back. And our investors are that's not their first choice, but they're okay with it because they know it's a plan B. I mentioned that before.
Right.
The borrowers don't want to come in with a plan B or plan C. We've got that in place with all of our investors up front. And, we pay our investors 9% currently. Maybe they would have to agree to go down to 7% or 8%. It would have to look at the cash flow numbers, but that's still better than the alternative of losing money.
Of zero or negative.
Right. As far as rates are concerned with us, what we pay our investors dictates what we charge. And at 9%, we've got a 3 to 4 point spread on interest rate. So we charge 12% throughout the bulk of the state of Wisconsin, and we charge 13% currently in Milwaukee. And it's really just to be 100% honest with you and your listeners, Milwaukee, we could probably charge more because our competition is charging 15%. So we don't really have any intentions of increasing our rates. We don't have a lot of junk fees. That's another thing your listeners really should consider looking at when they're looking at any lender. The interest rates might be much, much better, but their junk fees, I know of a lender within my state who charged something like $3,500 to get paid off. In order for you to pay the loan off, you had to pay a payoff fee, which is asinine. We see a lot of lenders that are charging several $100s to do a construction draw or a loan or an escrow draw for your construction proceeds.
Yeah,
that's your money as the borrower, and you now have to pay $300, $400, $500 to get your money out of escrow. It's crazy.
Yeah, I've seen that too.
So all these fees they're nuts. We do charge an extension fee if they go past our 6-month term, and it's equals to what if we were able to redeploy that money at another 12% and 3 origination points. So for an extension fee for us, it's a point per month, up to 3 more months. Why? Because we want that money back to redeploy it so we could charge 3 more points.
Right.
So, but it's not some 10 points and some crazy astronomical numbers. It's really just trying to get our same level return on our money, whether it's extended or redeployed to a new loan.
Okay. And people listening might be getting excited about using private money because it sounds like so much more flexible and just investor friendly. Other people might be a little bit scared hearing this. And so I'm wondering if you can talk to, if those people are listening, can they get involved on like the investor side of things where they're funding other people's deals and just clipping that 9% coupon or whatever the return is?
Yeah, absolutely. I mean, whether it's with me or with somebody else, I'm more than happy to talk to anybody about it. And if you invest with us, you do. If you don't, that's fine. But I would say there's some very important things that everyone should know. If you went and borrowed money from your family, okay, so maybe they're talking about a private lender being an individual that they have a relationship with, or they might be using somebody's retirement account. I've seen this happen so many times it makes me cringe. There was a young couple, I mentored them years ago. Now they're super successful, but they were just getting into the business, and they bought a flip house, and they said, we borrowed the money from my uncle at 2%, and we can pay it back when we sell the house. I said, that's fantastic. This was back before 2% was popular, right? And I said, okay, did you put a note and a mortgage in place to protect your uncle? And they said, no, he didn't care. He just said, pay me back when you get it, when you get the money. I said, okay, do you have the property insurance, listing them in case the place burns to the ground? Nope. Did you get them title insurance? Nope. all these things, like they did not protect their family at all. So picture them getting sued by a contractor or anybody. Here's a free and clear property without a recorded mortgage against it, and they lose it. Let's say they lose the lawsuit. Property gets taken away from them. Now they still owe their uncle all this money, and he had nothing to protect himself. Or we go back to they get hit by a bus walking out of the title company, right? Property, the money's gone. The money went to whoever they bought the property from. How does that family member collect or get their money back if they don't have a mortgage in place? They can't foreclose on the property and take the property back.
They have no claim to it.
So I just caution anybody that's, on the borrower side that's going to borrow money from friends or family, make sure you always get title insurance to protect your lender. The property insurance, the lender should be listed as a lender, not as an additional insured. There's a big difference. And, go through a title company, go through a closing attorney, make sure everything's above board, note and mortgage in place, or deed of trust, depending on your state. Because you're hurting your family if you don't do it the right way. So always protect your lender, no matter what. And if you're going to take a loss on a property or a project, I don't care what it takes, you make sure your lender is made whole. Because we've lent money to people that screwed up their deals, but they took care of us, and next time around, we lent them money again. But you got to take care of your lenders. On the other side of it, if you want to be a lender, there's a lot that you have to consider. Just the whole underwriting of the deal. Is it a good deal? Is it not a good deal? And how are you going to make sure that you get paid back? Are you going to have a third party that goes there and makes sure that the property is being managed right? Or if it's a rehab, are you going to have somebody that's checking on the project and releasing money on construction escrow draws? If you do want to collect monthly payments, who's going to do that? Who's going to service the loan? So there's a lot of things that, don't get me wrong, it's a great business, but there's a lot of things that people don't necessarily think about. And I've seen it happen enough times where, somebody has $100,000, $200,000, $300,000 sitting around, and they just do a handshake deal and lend the money to somebody. Again, not getting the proper documentation in place. We had one asshole, and I say that because he really was an asshole. He took money out of his disabled brother's IRA to fund a rehab project, and he had 3 other lenders on that project, and he told his lenders he was going to record all their mortgages for them, and he never recorded the mortgages. And it turned into this really nasty lawsuit, but he lost his disabled brother's IRA in that transaction. And he's just a snake, and they're out there.
Yeah.
But you got to protect yourself. I still believe in taking somebody at their word and believe in a handshake, but that doesn't mean you don't write down and memorialize what you just shook hands about.
Right. And if someone wants to get involved in the lending side of things, but what you just shared kind of makes them a little bit gun shy, or they want to have someone else take care of the day-to-day operations. I mean, are there businesses that they can plug into that say, here, take my money, pay me a return. I don't want to hear about it or know about what you're doing with it.
I mean, there's a lot of crowdfunding companies that, that became very popular. It seems to have died off here lately. I don't hear as much or see as much marketing about crowdfunding. I would say the best way to do it is either find somebody in your local market at a REIA meeting, or, in a meetup group, or even online, Bigger Pockets or something like that. But you got to spend some time getting to know who you're doing business with, and, Google the hell out of them, do background checks, all that kind of stuff. I invite anybody to Google me. I have nothing to hide. I never tried to screw anybody over, and I mean,
yeah,
and it shows. But at the end of the day, you've got to know, I don't think this will ever circle back around, but I was invited to be on somebody else's podcast, and I won't say the name, but then that gentleman was having a 4-day online conference, and he asked me to speak for 90 minutes on this conference. And I said, yeah, absolutely. I'd love to do it. He was expecting, 400 or 500 people. And so I was going to send it out to my email list and help advertise it for him. And it wasn't out there for 30 minutes. And two of my closest friends, one being a really good attorney, were emailing me saying, have you lost your frickin' marbles? Like, this guy is the biggest con artist and scammer there is. And he actually, the attorney sent me case studies of actual cases that this guy lost, and how he's not in jail, I don't know. And I was just, took him at his word. Hey, he's got a reputable podcast, right? So I'll go and speak on his conference. Well, who you associate with can reflect very horribly on you, especially on social media. So I didn't market to anybody at that point. I still spoke because I said I would, and I believe in, I gave my word, and there was a lot of other speakers at that event that were good, but I would never do business with that man. And so that's the same thing. If you're going to lend money or you're going to borrow money, do you want to borrow money from a lender that doesn't want to be flexible if you run into trouble?
Yeah.
For us, we've only had to foreclose on 9 properties in the last 10 or 11 years of lending.
Wow.
Which is very, very, very low as far as a default rate. That's not to say we haven't had other people that had problems, because we have borrowers that have problems every week. But we're there to help them work through it, versus the lender that's lending money as a backdoor way of getting properties.
It's a much more adversarial relationship. Right.
So you got to vet your lender, no different than if you were vetting somebody that you're going to invest with. We have a very clear, in writing, no policy within our company. I swear to God.
I love it.
If I have somebody that, and this has happened, I've had people that had several $1 million that approach us and said, we want to invest in your company. And after half an hour, 45 minutes of talking with them, we just knew they were going to be the biggest pain in our lives, and we turned them down. Same thing with our borrowers. If our borrowers stop communicating with us and stop, doing what we agreed for them to do, then the assholes policy kicks in, and we will have to default. We will have to foreclose, or at least we're not going to give them a loan next time. Mm-hmm. But life is a lot better when you wake up in the morning and enjoy doing what you're doing. And dealing with people that are not fun to deal with takes away from that.
Yeah.
So we just don't do it.
You just avoid it entirely.
So I'd love to work with any of your listeners, unless they're an asshole. Don't call me.
Hey, fair enough. Fair enough. And Derek, on that note, for people that do want to reach out, that do want to work with you, that have more questions about private lending, what's the best way for them to do so?
My personal email address is Derek, spelled DEREK, at bestreifunding.com. And I keep an eye on my own emails. If I miss something, my assistant will grab it. But I'd love to chat with anybody that's got questions. And again, this isn't a sales pitch. I mean, if somebody just has legit questions about lending and they have no intentions of wanting to work with me as an investor or whatever, that's totally fine. It's not about that for me. And then the other thing, I'm writing a book right now about lending, and from start to finish, what happens when an application comes in all the way through closing and servicing after the fact. And that's going to be coming out towards the tail end of the year, November, December, it'll be published. So I'd love to give your listeners that for free, the electronic version for free.
Awesome.
So they just send me an email, that same email address, Derek at bestreifunding, and say, hey, I heard you on this podcast, and put you on the list. When the book's published, we'll get it out to you.
Fantastic. Thank you so much. And I just have an ask for all of our listeners that do reach out to Derek. If you wouldn't mind, please referencing that you heard him on the Remote Real Estate Investor in the subject line, so he knows where you're coming to him from. That would be super helpful.
Absolutely.
Well, Derek, this was great, man. Thank you again for coming on the show. Really appreciate it. And I'm sure we'll be chatting soon. Can't wait to read the book.
Yeah, I can't wait to finish the book, because
yeah, I bet.
It's great when you're writing a book, except some weeks are more stressful than others trying to hit deadlines and stuff. So I'm looking forward to it, but I'm really looking forward to it being done too.
I can imagine. Well, hey man, we'll definitely be in touch soon.
Awesome. Thanks so much for having me.
You got it. Take care. All right, everyone. That was our episode. A big thank you to Derek for coming on again and sharing his time and knowledge with us. As always, if you enjoyed the episode, feel free to give us a rating or a review wherever it is you get your podcasts. And we look forward to seeing you in the next one. Happy investing.